Welcome to Different Makes a Difference, where we discuss investment matters that matter to everyday investors. Join Odlum Brown's equity analysts as we examine pertinent topics in today's markets and look at things a little differently. Odlum Brown is an independent Canadian investment firm. We provide integrated wealth management solutions to help clients achieve their financial goals, and we've been doing so for over 100 years. Join us for some lessons we've learned along the way that can make a difference for the future.
Hello, and welcome to Different Makes a Difference. I'm Stephen Boland, and I'm here today with Murray Leith. He's Odlum Brown's Chief Investment Officer. Welcome, Murray.
Good to see you, Steve.
So, Murray, this is your second time on the podcast, and a lot has happened since we recorded Navigating Trump 2.0 in early March. Investors have been on quite the roller coaster ride, with stocks tanking as Trump escalated the trade war and rallying as he de-escalated and found some peace with China. It's enough to make anyone dizzy, and yet the title you suggested for this conversation is Dazed But Not Confused. Can you explain why you're not confused?
Sure. On my way in this morning, I listened to our first podcast and I realized that as crazy as things have been over the last 2+ months, our view of the world and strategy have not changed at all. In fact, the major Canadian and U.S. stock benchmarks are higher than they were back then and in positive territory for the year to date. And I think for a lot of people, that's probably hard to believe. We had a big drawdown following Trump's shocking Liberation Day tariff announcement, but stocks have retraced all of those losses and then some as Trump de-escalated the trade war. For a while, investors worried that Trump was willing to kill the economy in an attempt to change trade patterns overnight and raise revenues. But in the end, he backed down materially, and investors realized that once again, Trump's bark is worse than his bite. And once again, it was art of the deal theatrics aimed at gaining negotiating leverage. While he certainly has been able to use tariffs or the threat of tariffs to further some goals, like getting NATO countries to meet their defense spending commitments, it's becoming increasingly clear that the shock and awe tactics are not working as well as he had hoped. Trump's approval rating is way down, and he's looking for off-ramps, it seems, all the time, left, right, and center. And that's a good thing. Don't get me wrong. Trump's antics are destabilizing, and I don't think there's any doubt that the tariffs and all the associated uncertainty will have a negative impact on economic growth. It's just that the hit to growth, I think, is going to be much less than feared. The important point is that our focus on diversification and owning quality, attractively priced businesses for the long term has not wavered. The message today is the same as it was 3 months ago. Stocks remain one of the best ways to preserve and grow wealth over the long term because the economy expands and corporate profits increase over time.
So pundits have pointed out that this recent U.S. market rally has been the fastest 15% plus rally since 1982. And some suggest that might be a good omen because often that's the beginning of a long bull market. I know you disagree, so can you tell our listeners why?
Sure, I just think it's a downright silly comparison. In my opinion, and I talked about this with our advisors at this week's internal meeting, stock valuations today are in a totally different galaxy. In the 1980s, the early 80s, inflation was sky high, and the Canadian and U.S. central banks had taken interest rates all the way up to 20% to get inflation under control. That crushed home and stock market valuations. Back then, U.S. stocks traded at less than 10 times earnings, and today they're north of 20 times earnings. We had back-to-back recessions in the early 80s, and corporate profit margins were very depressed. Today, U.S. profit margins are near record highs. So the setup is totally different today. You make the most money in the stock market when there's scope for improvement. And the odds of things getting better are best when the economy, profit margins, investor sentiment, and valuations are depressed. And that was certainly the case in the early 80s, which is why the 1980s and 90s were great decades for stocks. But as I said, the setup is different. It's opposite today. Economic growth is slowing because of excessive debt. protectionist policies, inflationary pressures, and geopolitical unrest. In general, valuations are relatively high and profit margins have more downside risks than upside potential. Now, that doesn't mean that there aren't opportunities and that we shouldn't be in the stock market, but it does mean that we have to be more selective and more price conscious. The popular stocks that have treated us best over the last decade probably won't be the leaders over the next decade.
The U.S. stock market has rallied almost 20% off its April lows after falling almost 20% from its high. A 20% fall is commonly defined as a bear market, but I've heard you say that it hasn't felt like a bear market. What do you mean by that?
Well, in real bear markets or bear markets that I've experienced historically, when stocks go down 20% or more, people are afraid to buy stocks. And this time, it didn't feel like investors were afraid. Many retail investors, I think, looked at it as a buying opportunity, and good for them, frankly, because that trade has worked out very well. But from my perspective, the mood of the market in the face of adversity has been unusual. I'm not sure people understand risk as well as they have historically. As the chief investment officer at Odlum, I'm the guy who's been writing the hand-holding notes in times of crisis for 30 years. And there are normally 3 ingredients when I write those notes. Number 1, the headlines are scary. 2, investors are anxious. And thirdly, stock valuations are normally very depressed. Well, today the headlines are definitely disturbing and we're all anxious. But there's also a fair amount of complacency. Perhaps we feel invincible because we survived the pandemic. Despite the world locking down, we had the shortest recession on record and the value of homes and stocks went up a lot. Perhaps that experience causes us to be optimistic. And that's not a bad thing, as the history of the world is that we do overcome challenges. So there is reason to be optimistic. But we also have to appreciate that stocks aren't super cheap like they normally are when the headlines are scary. The US market in particular is relatively expensive. The big silver lining in a crisis is normally extremely depressed stock valuations, and that's just not the case today. I think the other thing to remember is that big rallies are common in bear markets, and sometimes one should use those bounces as an opportunity to rebalance portfolios. When the dot-com bubble burst at the turn of the century, the U.S. market fell 50% from its high in 2000 to its low in 2002. But on the way down, there were 6 major counter-trend rallies. 3 of them were close to 20%, and the other 3 were close to 10%. I'm not sharing those facts because I'm trying to scare investors and suggest that you should get out of the market. As you know, we don't believe in market timing because we don't believe we can predict the short-term moves in the market. We do well when we focus on what we pay for businesses and where we think they're going to be in 3 to 5 years, not by trying to figure out if the employment report is going to be good or bad or how investors are going to think. In the 2000s, although it was a tough decade for both technology and big American stocks because they were very expensive at the beginning of the decade, this situation is not exactly the same today, but it rhymes. America's biggest and best companies are once again relatively expensive, and that increases the odds that they won't be the leaders in the decade ahead. But there were plenty of stocks that did well in the 2000s. It just wasn't the stars from the 90s. When we have big rallies, investors tend to flock back to the stocks that have treated them best in the past. And that's creating opportunities, I think, to harvest profits and redeploy money into stocks with better valuations. And that's certainly what we've been doing recently.
On the topic of valuation, let's get into the weeds a little and talk about profit margins, and U.S. profit margins in particular. They are high from both a cyclical and long-term secular perspective, and that's an important consideration when thinking about valuation, which doesn't always get discussed. Can you tell us why it's important?
Yeah, sure. I think it'd be good to start with some basics, sort of valuation 101, and explain how profit margins are part of the analysis. So we'll start with that. The most common valuation metric used by investors and the media is the price-earnings ratio. Just as an example, a company that generates $2 of earnings per share and trades at $30 has a PE multiple of 15 times. That's the $30 stock price divided by $2 of earnings. People sometimes say or think that a stock with a price-earnings ratio or PE multiple of 20 is more expensive than a stock with a PE of 15, but it's not that simple. The company with the higher PE ratio might be cheaper if the company is more profitable and growing faster. What really matters is how fast earnings, or the E in the PE equation, will grow, and that in turn will influence the other factor that matters, whether the valuation multiple, the PE ratio, will rise or fall over time. It's a combination of the growth in the earnings and the change in the valuation multiple over time that ultimately determines the rate of return for the stock. The rate of earnings growth is a function of two factors: the rate at which sales grow and the change in profit margins. And so we spend a lot of time thinking about both, primarily from a bottom-up, company-by-company basis, as you know. But today we're going to talk about margins from a top-down, general perspective. And we'll focus on the US market because that's where margins are both awesome and vulnerable. Just for, some historic perspective, from the 1950s through to the great financial crisis in 2008, US profit margins averaged about 7%, and the range was from about 5% to 8%. Since the financial crisis, they've broken out to a new higher range of 8 to 11%, and we're currently at the top end of that range. Now, earlier on, I said that it was silly to compare today's market to the market in the early 80s, and one of the reasons was the big difference in profit margins. Back then, they were about 5.5%, sort of half of what they are today. So the doubling of profit margins over the last 45 years is one of the big reasons US stock returns have been so great for so long.
So what have been the key drivers of improved profit margins over the last few decades? And more importantly, can you tell us whether you think there will be headwinds or tailwinds going forward?
Yeah, sure. There's a number of factors, and sort of we'll go through each of them. Lower interest rates have been a big driver of improved margins as it's gotten cheaper and cheaper to borrow. Interest rates went from record highs in the early 80s, back when the central banks had administered interest rates up to 20%, to record lows in the aftermath of the financial crisis and even lower during the pandemic. But interest rates have been a headwind since then as they've normalized at higher levels. When we think about free trade and globalization, that created a lot of deflation in goods prices as companies took advantage of cheap overseas labor. Between 1995 and 2020, that 25-year stretch, goods prices in the US dropped roughly 40%. And that kept overall inflation very low. And that in turn helped central banks keep interest rates very low. And it also allowed them to print money without creating inflation. But that ship has sailed. The world is getting more protectionist and interest rates are higher, in part because inflation is higher. The next factor is lower corporate taxes. They've generally fallen over time and contributed to higher profit margins. Now, Trump, of course, wants to lower them even further, but that could be a challenge given that America is running a huge budget deficit during good times. And we'll be watching the negotiations in Congress around taxes and whatnot coming up soon. The next factor is, globalization and free trade. It's had a massive positive influence on profit margins as companies have been able to leverage cheap overseas labor. That's going to be much tougher going forward. With tariffs and less immigration, labor is in a better position to negotiate higher wages. The pendulum swung very far in favor of capital or business for many, many years. And not that we think it's going to swing way back in the other direction, but it's going to swing back, or it is already swinging back in favor of labor somewhat. Technology has been a big factor in improved margins too. Not only do America's big technology companies command high margins, but the biggest and best companies have been able to leverage technology to improve margins. And probably they're able to do it more so than medium and smaller sized companies. But do you remember when the internet was in its infancy? Everything was free when companies were racing to build their customer bases, to get clicks and eyeballs. But now we pay subscriptions for everything. Well, now there's a race on to dominate in AI. And I wonder if that's going to create pressure on margins in the near term. It used to be that the big companies, the so-called Magnificent Seven, competed in their own lanes, but now they compete with each other. And they also face competition from new entrants. They're spending hundreds of billions of dollars building infrastructure, and it's not yet clear how they will get a return on those huge investments. Not saying that they're not going to ultimately, but they might put pressure on margins in the near term. Governments are increasingly scrutinizing the behavior of the big companies that have the fat profit margins. After the big antitrust case against Microsoft for Internet Explorer around the turn of the century, there really weren't any big antitrust cases for about 2 decades. Well, there's lots today. I don't know if the big guys will get broken up, but they're definitely not able to operate or do acquisitions as freely as they used to. Finally, the Trump administration's big goals of reducing the budget and trade deficits, those are other factors that could have a negative influence on margins. And I'm not going to get into the mechanics of that because it's fairly complicated and convoluted, but that sort of is an additional factor that sort of plays into our thinking. The bottom line is that U.S. profit margins are at record highs, and there's a lot of reasons to believe that they'll revert to lower levels over time. So when you combine the potential for profit margin pressure with the fact that U.S. valuations are generally high, it translates into a muted outlook for U.S. stocks. I'd argue that those two factors, and not Trump, explain why the U.S. stock market's been the worst performing market in the world this year.
So that sounds a bit bleak. Does that mean we should be getting out of the U.S. market altogether? Maybe investing more in Canada and overseas?
Absolutely not. That's not the point that I want listeners to take away. What I'm saying is that the broadly based U.S. S&P 500 index will probably be a global laggard over the next decade because it's dominated by huge, popular, and pricey stocks. Some of the companies in that index will continue to do well as businesses and as stocks, but many won't because they're pricey, and that will weigh on the performance of the overall index. Buying and holding the U.S. S&P 500 has been a popular and low-cost strategy that's generally worked well over time. But there are times when it doesn't work well, and that's when it's expensive. But the American market is huge, and there's a lot of attractively priced stocks. In the 2000s, plenty of U.S. stocks did well, while the benchmark did poorly. Our clients did well, owning a lot of U.S. stocks. We've spent time looking overseas to see if there's better value, and the general conclusion is that you have to pay up for quality in all geographies. The big valuation differences between markets has more to do with sector concentrations and differences in the makeup of the individual markets than the valuation differences between stocks in the same sectors. We're still finding good value in North America, and there's a lot to be said about investing closer to home in familiar businesses. It greatly reduces the chance of emotional mistakes in uncertain times.
Well, I think that's great advice. So let me sum up by saying it sounds like you're dazed but not confused, because the formula for successful investing has not changed. It has always been about having a long-term focus and owning quality businesses that trade at attractive valuations. So thank you, Murray, for being here today. Thanks to everyone for listening. We hope you enjoyed the podcast. If you did, please click the subscribe button and you'll get notified of future episodes. In the meantime, hope you enjoy the rest of your day, and we look forward to chatting again soon.
Thank you for listening to another episode of Different Makes a Difference. Just as every individual is unique, so are your financial circumstances. Be sure to talk to your professional advisors for advice related specifically to you. Our podcast is for general information purposes for Canadians only. The views expressed are those of the presenters and may not reflect the opinions of Odlum Brown. Be sure to check out our full disclaimer and subscribe to the podcast at odlumbrown.com/differentmakesadifference. Odlum Brown is a member of the Canadian Investor Protection Fund.